Well, hello there, my friends, and welcome to another edition of Eco Crypto Educate. Today we're going to be talking about the bankruptcy case of Silicon Valley Bank and what it teaches us. Contrary to what one might believe, the leaders of Silicon Valley Bank were not lacking in foresight. They simply lacked experience in risk management. Let me explain. In 2008, banks had done just about anything. They had lent to anyone, any way they could, underestimated the risk, and committed beyond their means. Some, like the investment bank Lehman Brothers, simply ended up ruined. The fault lay with the lack of foresight. In 2023, the situation is quite different. Banks have become more restrained and have purchased U.S. Treasury bonds, which is the safest asset, thinking that the Fed would not raise its interest rates. But the Fed not only raised its interest rate significantly but also did it quickly. Very quickly. In other words, if banks bought a 10-year Treasury bond when yields were 1.5% and they are now 4%, these old Treasury bonds are less attractive. So, the earlier bonds see their market value drop, and they will be discounted by about 15% to 20% by potential buyers. Idea is that the market arranges for both Treasury bonds to have the same effective yield at maturity regardless of whether they are old or newer. If a bank like Silicon Valley Bank bought many Treasury bonds when interest rates were low and money was flowing, these assets, heavily discounted if they had to be sold, become an unrealized loss in the bank's books. I say unrealized because, as always in finance, as long as it's not sold, it's not lost. So far, these losses are only latent, unrealized. If the bank lets the duration of its bonds, the holding period set at the outset, expire, it will get its money back and will not suffer any loss. It will even have received an interest rate or coupon. But here's where things go wrong. Nothing happens. As long as customers do not withdraw their money from the bank. What happens if customers decide to withdraw their cash from the bank? The bank must sell the Treasury bonds at a discounted value and realize the loss. Sold, lost. Too few customers and some smart ones. And it's a bank run. All customers want to withdraw their money at the same time, it's bankruptcy. It appears that Peter Thiel, former co-founder of PayPal and CEO of Palantir, initiated the cash withdrawal movement.
As John Told says in the movie Margin Call, there are only 3 ways to make money in finance: be first, be smart, or cheat.
Seems that Peter Thiel hasn't been only the first but also the smartest of Silicon Valley Bank's customers. He's being blamed for triggering the movement. I think that's unfair. He simply protected his interests. Being first to get out of a bad situation rather than being stuck seems to me to be common sense. It will always be time to save others if you make sure to save yourself first. This is the same reason why you have to put on your oxygen mask in case of a plane crash before trying to help others. Anyway, we should not underestimate the importance of experience in the subject of risk management. Good intentions are not enough when it comes to risk. That's it for today, folks. Thank you for watching this video and for learning with us. Until next time, stay free to choose. Don't forget to like, share, and subscribe.